Hello everyone, I'm Christina. Today me and my group mate are going to present topic 4, Big Bath. There's no company in this world who commit to use Big Bath because it is accounting tricks that benefit themselves. But there are examples that can tell us what action can be called Big Bath. For example, usually no matter there is a loss or profit, businesses are required to pay bonus to employees. But the business stating that because of the large environment that causes the financial crisis to the whole industry, and they claim there is a loss this year, so the business provide no bonus to its employees. That sounds reasonable, right? But when it happened to apply to Big Bath, it is a way to decrease expenses so that they can able to report a higher earning next year and provide bonuses accordingly. And to create an illusion to the public that the higher earnings is because of the company perform better, but for real, it's because they cut down expenses that they were supposed to pay last year. Second, some business may create for sales record, but that should demand they have a match with their account receivable. So in the following year, they write off this amount of account receivable to state that because of the overall performance, they made losses or outgoing. The last example is that in a company, there is a situation that management level might think that the target sales or performance cannot be reached in the current year, so that they shift some amount of the profit that they expected to earn in making write-off or preparing expenses. Then they can show an inflation profit in the next year for everything that they gain improvement. Advantages that companies can gain from this trick is that it is a source to earn more bonuses and profits in the successive year. Second is that they might be able to attract potential investor because their company can't perform even worse than now, so that they can have large base of improvement in their company for their profit earning capacity shortly. The company can provide a sense of having a large difference in their profit earning to show from a loss to a gain to investor, so that to let them see their potential. Last is that Big Bath can also be a strategy to clean up a company's balance sheet, because company can settle all its losses in one go. And to do that in the loss-making years. So in conclusion, Big Bath is an accounting trick that many companies might use when there is a period that the overall business environment bring a bad performance to the whole industry, like the impact came along with the COVID-19. And company can clean up their bad records at this stage to show that to the public that the bad performance is not because of the company itself's performance, but was because of the big environment. Next will be the discussion of the impairment of assets. Thank you.
Thank you, Christina. Impairment refers to a permanent reduction in the value of an asset. This includes both fixed assets and intangible assets. Impairment can occur as the result of an event such as a natural disaster or change in consumer demand. An impaired asset is an accounting term that describes an asset with a recoverable value or fair market value that is lower than its carrying value. Companies need to test for assets for impairment regularly to ensure that their values are accurate in their balance sheet. In the case of a fixed asset impairment, the company needs to decrease its book value in the balance sheet and recognize a loss in the income statement. An advantage of allowing managers to impair assets would be to highlight company management. Impairment can benefit organizations by highlighting the importance of asset awareness when preparing its balance sheets. If the company handles impairments properly, it can create opportunities to gain support from investors by not only following correct accounting principles, but also demonstrating successful management within a challenging market condition. Investors are more likely to invest in companies that have experienced difficult market conditions and succeeded in spite of them, rather than backing untested businesses who have not proven that they are able to stay resilient. Impairment charges provide investors and analysts with different ways to assess a company's management and decision-making track record. Managers who write off or write down assets because of impairment might not have made good investment decisions or lacked the vision to make that kind of investment beforehand. An additional benefit would be that it would smoothen loss of sales. Asset impairment can also smoothen the loss of sales when the asset is disposed of. If an asset is continually depreciated at an underestimated amount, the asset will be reported at a book value that is higher than its market value, and this gap then expands over time. When the asset is sold at the market value after several years, the company will realize a large loss. Instead, if the company records impairments periodically, the book value of the asset will better align with the market value, and the large loss will instead be recognized over several impairment losses instead of just at once. Thank you.
Thank you, though. A big basket action can make the company's future look attractive, but manipulating the big basket may cause it to lose its reliability and relevance to the company's financial statement. A prescribed schedule for companies to amortize or depreciate their assets can effectively avoid the potential big basket action. It allows companies to record the impairment and depreciation of assets on time and accurately, thereby avoiding the company's free decision-making power over assets and making its financial statement more reliable and relevant. Investors and creditors have more transparent and fair public information to invest in, and banks and borrowers have more precise risk assessment, which provides accuracy and fairness to also investors. For instance, many countries encourage economic recovery policies after COVID-19. Companies may depreciate or amortize a massive amount of assets to prepare for future sales to boost and attract investors, but companies must show an enhanced profit every following year. And if this doesn't show the expected result, investors may back out of the firm. Suppose the company has a considerable impairment of assets to prepare for future profits. In that case, investors will be more willing to invest in its future profitability. Still, it will not make so much. The future will add back a large amount of previously impaired money, which will cause misleading investors. From the perspective of accounting supervision, the prescribed schedule will also be easier to check the statements, which can process through the established procedures. Goodwill's impairment test will be more objective and accurate because in the consolidation report, underestimating our acquired assets and overestimating the acquired liabilities will result in high goodwill. The current accounting standards do not require amortization of goodwill, but do periodic impairment testing. Indeed, the impairment test is very flexible. The prescribed schedule can largely avoid the suspicion of fraud because the company must work under GAAP guidance. Any significant changes that do not meet a GAAP guidance may lead to fraudulent activities. For example, listed companies' losses for 3 consecutive years will require trading to be suspended as listed companies. The company may adopt a big bet method to avoid delisting. Massive impairment of assets in a period will result in a violation of consistency and prudence under GAAP. If the prescribed schedule is needed to record the company's impairment, will allow GAAP to obtain better protection and improvement, thus genuinely achieving the 10 GAAP principles.
Thank you, William. So next, let's talk about which approach is more preferable. The first one is granting managers the flexibility to charge impairments on assets. When discussing this approach, one of the conditions to be met is that its recoverable value should be significant as it is a preparation for overstatement of earnings in future years. The future benefits it can give are worthwhile for managers to impair the asset and for the company to regularly test the asset for impairment. Otherwise, it is unnecessary to do so. In addition, it requires managers to be pre-trained and have the ability to make sound decisions, as the flexibility given to managers to impair assets comes with risk. It is the right attitude for the company to expect managers' decisions to be profitable and to be prepared for risks. In this regard, giving managers the flexibility to impair assets reflects a company's internal organizational capabilities, as companies can gain the opportunity to be selected by investors by dealing with impairments in a challenging external market environment. The decision-making ability of managers, the company's resilience, and the organization of the company are essential to the success in such conditions. Moreover, this approach also tends to occur when new management comes on board and after a company is acquired, and the new management tends to underperform the company and put the blame on their predecessors. When a company is about to be acquired, it is a good time for managers to impair their assets. They don't have to worry about the impact that will have on the business itself, because the fact that the company was originally about to be acquired indicates that the previous losses the company had incurred were irrecoverable, and management's over-recognition of losses or expenses does not have too much practical impact. Not only that, but if the new managers take advantage of this, they can bring a new lease of life to the acquired subsidiary and bring a new market competitiveness to the parent company. As an example, when Kelon Electrical was acquired, the new management used this to effectively improve the company's actual operations. This shows that it is more feasible to give managers the flexibility to impair assets when a company is about to be acquired. Thank you.
So when the preferable approach is the prescribed schedule, the first point is that require companies to depreciate or amortize their assets according to a prescribed schedule would definitely be easier for the accounting regulators, since they can check the financial reports of the companies based on current established procedures. It also reduces the workload of them. For the companies, it would become difficult for them to take advantages of the earning management and narrow down their under-table operations. But with that being said, there are also advantages to companies. So the second point is that as to qualitative characteristics of the financial reports, the schedules would make companies fulfill the relevance and the faithful representations of fundamental qualitative characteristics. Hence, companies would take benefits from the prescribed schedule. Also, if the schedule is established, they can avoid making careless mistakes by keeping aligning to it. However, the third point is that it will be too strict, stiff, and lack of alternative if there are no flexibilities for the companies at all. In my opinion, we could let the managers argue with the regulators about certain schedules and then make the schedule a bit more broader. For example, if the company's revenue is decreasing significantly due to the force majeure factor, such as travel and the entertainment restrictions regarding the COVID-19 in this case, then it will be more understandable to give the managers the flexibilities of charging impairments on assets. For the regulators, they could add another requirement, which is when the managers decide to charge impairments on assets, they must show the evidence, comprehensive calculations, and thorough explanations, and then make them available to the public. Hence, in this way, both sides would be satisfied. For the conclusion, the preferable approach for the regulatory perspective would be the prescribed schedule. But this kind of problem cannot be solved by only one side. Since the managers are usually the frontier to customers and the markets, their decisions cannot be neglected. Hence, if they can give convincing evidence, their discretions to take the large impairments should be adopted. That's all. Thank you for listening.